Welcome to Crypto Daily, where you'll find the latest news and analysis on all things crypto and NFT related. Hit the subscribe button and join our community of crypto enthusiasts. Let's navigate this exciting world of digital currencies together. Surgical removal of crypto will only weaken USD dominance, commentators say. Well. It looks like the US government is at it again with their crackdown on cryptocurrencies and crypto firms. Just when we thought they were starting to warm up to the idea of digital assets, they hit Coinbase with a Wells notice from the Securities and Exchange Commission. And if that wasn't enough, they're also going after Paxos, and who knows who else is next. Talk about being a buzzkill. But hold on a second, let's take a step back and think about what this really means. According to industry commentators, this move by the US government is only going to stifle innovation and weaken the country. In fact, some are even saying that this crackdown is part of a scheme to unbank the crypto sector. Is this some sort of Operation Choke Point 2.0? It sure seems like it. Mati Greenspan, the chief of crypto research firm Quantum Economics, believes that US regulators have been unfriendly to crypto since the beginning. And the recent economic report from the White House was not exactly glowing about crypto assets, spending almost an entire chapter debunking their benefits. But hey, who needs benefits when you can just stick with good old US dollars, am I right? But Adrian Perzolozny, the CEO of Australian crypto exchange Independent Reserve, has a different take. He believes that the recent banking sector woes were not caused by any failure in crypto, but rather by banks managing their risks in an irresponsible way. He suggests that the White House would be better served to review the practices in the banking industry. And who knows, maybe they could even learn a thing or two from the crypto industry about how to manage risks. Speaking of risks, the exact reasons why the regulator is targeting Coinbase are still unclear. But one thing is for sure. This adversarial environment for the crypto industry in the US is not doing anyone any favors. Perzolozny thinks that it will push jobs, investment, and future innovation offshore. Countries like Singapore, Hong Kong, and Australia are already eyeing the benefits of the crypto industry and are ready to reap the economic benefits. But wait a minute. What about regulatory compliance? We've been asking for clarity on how to comply for years now, but it seems like we're still in the dark. And until governments lay out the path to regulatory compliance, offshore jurisdictions will continue harboring crypto firms. This will cost jobs and raise the risk for consumers and investors. So what's the bottom line here? It looks like the US government is trying to surgically remove crypto from their economy, but in doing so, they may only be weakening their own dominance. And who knows, maybe they'll end up regretting this move and wishing they had embraced the crypto industry with open arms. Only time will tell. Can Bitcoin, BTC, price really reach $1 million in the next 90 days? Are you ready to talk Bitcoin, BTC? Great, because there's a lot going on in the cryptocurrency world, and we need to keep up. First off, let's talk about the elephant in the room. Can Bitcoin reach a $1 million per coin valuation in the next 90 days? It's an exciting prospect and something that Balaji Srinivasan, Coinbase's former CTO, believes could happen. In fact, he's so confident in Bitcoin's future that he's wagered $2 million on its success. So, what's driving this bullish outlook on Bitcoin? Well, one of the main factors is the possibility of hyperinflation occurring in the United States. If that happens, Bitcoin's market cap could increase substantially, leading to a $1 million valuation per coin. But there are some obstacles to overcome. For starters, to reach a $1 million valuation per coin, Bitcoin's market cap would need to skyrocket to $20 trillion. That would require a massive influx of cash into the cryptocurrency market, which would be fueled by increased adoption and investment. But there are some liquidity and infrastructure concerns that could impede Bitcoin's growth. The cryptocurrency market is notoriously volatile and has experienced significant liquidity shortages during periods of high volatility. Additionally, exchanges may struggle to handle huge trading volume surges, leading to outages and frustration for traders and investors. Another thing to consider when assessing Bitcoin's growth potential is its market dominance. Currently, Bitcoin dominates the cryptocurrency market, accounting for around 45% of the total market capitalization. But, if BTC were to achieve 65% market dominance, it could significantly impact alternative cryptocurrencies, possibly leading to their decline. Of course, with all great rewards comes great risks. Regulatory uncertainty remains a significant challenge for the cryptocurrency industry as governments worldwide grapple with cryptocurrency regulation. Additionally, the environmental impact of Bitcoin's energy-intensive mining process has come under scrutiny. But, let's think about the wider implications of Bitcoin's potential growth and market dominance. A surge in Bitcoin's valuation could boost overall cryptocurrency interest, which could spur altcoin adoption and push traditional financial institutions to integrate cryptocurrencies in their models. Speaking of traditional financial institutions, a $1 million valuation for BTC would have far-reaching implications for the legacy financial system, encompassing central banks, governments, and traditional financial institutions. The potential consequences of such a milestone are manifold and could lead to a significant transformation of the financial landscape. Central banks could explore new strategies, including digital currencies, to maintain economic stability and manage inflation within their policy frameworks. Governments may fast-track central bank digital currencies, CBDCs, to maintain monetary control and preserve national currency's relevance in a digital financial world. Furthermore, a $1 million Bitcoin valuation would likely accelerate the integration of cryptocurrencies within traditional financial institutions. They may need to adjust their models for growing crypto demand, offering related services, and developing new products. This would blend traditional finance with the digital asset ecosystem. But, of course, governments would need to revisit their fiscal policies and taxation frameworks in response to BTC's increasing valuation and adoption. This might entail updating tax regulations to account for the nuances of cryptocurrencies, including capital gains, income tax, and cross-border transactions. Governments may also have to consider the implications of cryptocurrencies on their revenue streams and adjust their fiscal policies accordingly. Overall, a $1 million Bitcoin valuation would have profound implications for the legacy financial system, impacting central banks, governments, and traditional financial institutions. It could reshape monetary policies, drive digital currency development, transform finance, and redefine fiscal policies. But it also poses challenges that require coordinated regulation. Now, we know that reaching a $1 million valuation per coin within 3 months seems improbable, but considering factors that could drive such a milestone is essential. Undoubtedly, Bitcoin's future remains unpredictable, but as more people adopt it, invest in it, and integrate it into their financial lives, its potential to transform the financial system becomes increasingly apparent. It's clear that Bitcoin has come a long way since its inception in 2009, and the next few years will undoubtedly be exciting for crypto enthusiasts and traditional financial institutions alike. Whether Bitcoin can reach a $1 million valuation per coin within the next 90 days or not, its impact on the financial system is undeniable. As with any investment, it's essential to consider the risks and rewards associated with Bitcoin and other cryptocurrencies carefully. But, for those who believe in Bitcoin's future, there's no doubt that it could play a pivotal role in shaping the financial landscape in the years to come. ChatGPT can now access the internet with new OpenAI plugins. Have you heard the latest news from OpenAI? The team behind the revolutionary artificial intelligence chatbot, ChatGPT, has just released a brand new feature that allows it to access the internet and retrieve information from online sources. That's right, ChatGPT can now interact with third-party websites via a new plugin feature, and it's causing quite a stir in the tech world. Now, before you get too excited, let me tell you that the plugin feature is still in its limited alpha phase and will only be available to a small set of users initially. OpenAI wants to study their real-world use and impact before rolling it out to a larger audience. But still, this is a huge step forward for ChatGPT and the field of artificial intelligence as a whole. So, how does it work? Well, ChatGPT utilizes the Bing API to search for information, along with a text-based web browser to navigate results and interact with websites. It can synthesize information across multiple sources to give a more grounded response, and it cites the sources it used so users can verify where ChatGPT derived its response from. This is a great feature, as it helps to build trust between ChatGPT and its users, and it also makes it easier for users to fact-check the information they receive. Initially, there will only be 11 plugins available, ranging from allowing users to check the scores of live sporting events to booking an international flight and purchasing food for home delivery. But OpenAI is gradually rolling out plugins so that it can assess their real-world use. Among the cohort of websites that are supported by the new plugin feature are e-commerce platforms Shopify, Klarna, and Instacart, and travel search engines Expedia and Kayak. The plugins also include the math computer Wolfram for carrying out calculations and the business messaging app Slack. The addition of plugins that access the internet could improve one of ChatGPT's biggest shortfalls, which is that it was trained with data only up to September 2021 and does not have access to the internet to grab more recent information. With the new plugin feature, ChatGPT can now retrieve the latest information from the internet, making it even more useful and reliable for its users. It's no surprise that the demand for this new feature has been high since the launch of ChatGPT on November 30th. In fact, OpenAI recently released the latest version of its artificial intelligence chatbot, ChatGPT-4. So far, the new version has already managed to successfully pass many of the toughest U.S. high school and law school exams in the 90th percentile. That's pretty impressive, right? Using the same version, Cointelegraph recently launched an experiment using GPT-4 to invest in cryptocurrencies using information fed from Cointelegraph markets and a selection of Cointelegraph's daily news, with the aim of understanding how it interprets news to make trading decisions. The results of the experiment are still being analyzed, but it's clear that ChatGPT is already making waves in the world of finance and investment. Overall, the new plugin feature is a huge step forward for ChatGPT and the field of artificial intelligence. It's exciting to think about the possibilities that this new feature opens up, and we can't wait to see what other developments OpenAI has in store for us in the future. Who knows, maybe ChatGPT will even be able to order pizza for us one day. Crypto Daily, your source for the latest crypto and NFT news.